What up? Zach Bradshaw, long-winded guy here. And in this video, I'm going to talk about my concept of playing markets and really detail what this is. And part of it is inspired by something that a friend suggested to me recently, and I did not like that suggestion because I felt like they were probably suggesting that to other people, and I thought it was a bad suggestion. But it wasn't from a bad place. It was to help people, increase their chances of financial freedom, and that is really what playing markets, part of what it's about, for me. And I think that the way that I think about it will be helpful for people. And I never hear anybody talk about finance in this way. So there's a couple of different things, and one of these comes down to the fact that, well, I don't know if I should call it the fact, but something that I hear often from some of the people who, people I respect when it comes to money and entrepreneurship and investing and things like that. One of the things I often hear them say is, like, the first rule of money is to not lose your money. And so there's a side of investing and trading and finance that has to be devoted to when shit hits the fan, because that happens. And so there's um, different things that you can do that are different from like just trying to make money. There's risk, and then there's also reward. And it's important to understand how those work. And then this is the part that I don't think that I hear anybody ever talk about, is the fact that the value of things is not really there. It's not permanent enough for you to, uh, how can I say it? For you to count any gains, whether realized in any specific way. And there's two things that I want to point out to kind of illustrate this, or make the concept, like, point out, just explain what I'm trying to mean here. So one of them is the fact that things like market cap, things like the price of something right now, or the total amount of money that is in a system or value is in a system, is never a real thing. It's never a tangible thing. And so when, for example, with Bitcoin, for example, even when a price reaches something like $20,000, if everybody at that point that is $20,000 wants to sell at that point, then that is going to immediately push that price back down. And obviously, that's how markets work. If more people want to sell, then the price goes down. If more people want to buy, then the price goes up. But the issue comes when people are looking at something like the S&P 500, which is kind of like a gauge for all of the United States economic growth, and we're looking at it, in a financial instrument that may not necessarily be, exactly apples to apples with our production and like what those companies really have, because it's a public sentiment on the value of those things. So when we look at something like the stock market and we say it's, I don't know, I literally have no idea what the value would be, but let's just say it's $300 trillion, is the total value of the United States stock market. It's probably not that high. Let's say $50 trillion is the total value of the United States stock market. Well, if things go bad, if things start to turn down, if a recession comes, then very quickly trillions of dollars is going to be shaved off of that. And it's not because anybody necessarily loses anything. It's because people lose faith in whatever assets they're holding. So it's not like when a recession comes, Apple stock doesn't go down necessarily, certainly because the company may be doing worse. But it goes down proportionate to people's sentiment about Apple's company, which is not necessarily the same thing. And if you think about it long enough, you're going to see that all prices of these types of things are like fictional and made up, and they can crash and they can come down 10%, they can come down 20%, but they can also go all the way to zero. We could all lose faith in the stock market. And so people who think, or people who think they have $1 million, or everybody thinking they have $50 trillion in this thing, Well, as soon as we don't think that and we lose the confidence in that, that goes to half. That goes to a quarter of what it was. And you see that very easily in an immature market like cryptocurrency, like Bitcoin, where there's not trillions of dollars in it yet. And that's the thing, is that even in a market like the stock market, even if there's trillions of dollars in it, there's not necessarily trillions of dollars in it. Because as soon as people get scared and want to sell that money to get their $1 trillion back, the value of everything starts to go down. So, if you think your stuff is worth $100 million, and you, along with everybody else, is like, whoa, let me cash this out so I can keep that $100 trillion or $100 million, then it's going to be $75 million. And if you're not acting fast enough, then it's going to be 50 million. It's going to be 25 million. And certainly, are we ever going to see a 99% crash in the total global economy? Probably not. But there's a piece to the puzzle that is really important, and it's somewhat illustrated by this. And so diversification is, I like how Grant Cardone kind of says diversification is for wimps, in that if you want to make a lot of money, then you need to risk things in order to get the most. But if you want to make money off of your money, you can't lose your money. So diversifying it in certain ways makes good sense. And then there's the fact that anything you're holding, people generally think about like how much money they have in their account, how much money they have in, their investments or whatever else. I think it makes more sense to look at your rank in terms of everyone else, because it's a really, really, really complicated system. And if you see this with currencies a lot, where if the United States, if the dollar gets 2% stronger against the pound, that essentially means that all Americans holding dollars just got 2% richer than everybody that's living in Great Britain or using the pound. And so there's an aspect of this that, okay, so for example, if there's a portion of the population that is 20xing or 100xing their money by investing in cryptocurrency, then my rank is now deteriorating based on that. And so obviously there's other factors when it comes to total employment and recessions across the world and market cycles, all this crap, where just because, let's say 10,000 people are getting a disproportionate velocity of income increase, essentially, like how fast is your income increasing, just because some people are getting a disproportionate amount there for a limited time, my rank still may be going up, because there could be other things that are helping me to go up as well, even if I'm, say, at an average velocity increase for my demographics or whatever. And so it's understanding, when I talk about playing markets, it's understanding where to have your money win, and when to have money, and when to have things that you can sell for money. And it's really complicated. There's a lot to it, and there's literally an infinite number of things you can buy and sell. Certainly you can invest in real estate and the stock market and cryptocurrency if you want to, but you can also invest in things like sneakers, sit on them, let them 10x over a decade, and then sell them. You can, collectibles like art. There's all types of things that, depending on what you're doing with them, or can grow in value, or decrease in value. And it's people don't, me saying that, whatever, people don't really think about this concept in the first place, but that the concept extends also to things in life that you're buying that may be losing value. So like buying an old crappy car for $1,000 is not going to lose its value as quickly as buying a $20,000 car, fresh off the lot. But that $1,000 car is going to go to zero much sooner than that 20,000. As soon as you drive it off the lot, that 20,000, it immediately became 18,000. Sure, you lose 10%. But that thing is going to have higher resale value over time. And it could be such that inflation and these other issues that are under the playing markets principle, that these other things now affect sure, you lost your 10%, but now because you live in America, because these other things happen, that $18,000 that your car is worth is actually worth more than that $20,000 that you had before the car. And that's hard to explain because like you're looking at it as dollars as the scale, but dollars may not always be the scale. And so if dollars start to lose their value to something like gold or to something like Bitcoin, you that 18,000, like there's just a lot of moving parts. And so let me play this little Ray Dalio video. This is probably not the way to do this on YouTube, but I'm just gonna like play it right here because he doesn't do the best job explaining it. And if I just like let him talk and then talk over it, then this is going to be very useful for you know, anybody I want to show this to, and also to elaborate my point on playing markets. So
the real question for me was, what would marginal benefits of diversification like? How would, you know, what does that look like? Okay. And what I then decided to do was to think about risk and the number of sample size and the correlation of the bets, broke it down to each of its components, right? So to use an example, let's assume you have, make it simple, a return, something that has a 10% risk. We'll call risk standard deviation. And let's make it simple, and let's say it had a 10% return. And let's say I add in another asset, another return stream. I add in a second, a third, a fourth, a fifth, up to whatever number. How would that reduce my risk if it on average has a 60% correlation? Or if it has on average has a 40% correlation, or a 0% correlation? How would that change? Well, I didn't know that, right? So that's what this chart shows, right? And so, so imagine you have a 10% average return. You don't know which bet is going to be better. Has a 10% average return and a 10% risk. And you add in a second and a third and so on. You're not going to lose the 10% because you're still going to have that 10% return, but you're going to then have a reduction, and that's the reduction in risk. And if it has a 60% correlation and you have 3 or 4, you will get a reduction that maybe is about 15%. And you could add in 1,000 if they're 60% correlated, and you're not going to reduce your risk much. Okay, that's important. Now, if I look at that, how that changes according to the levels of the correlation, I start to think, well, what would happen if I added in something that had a 10% correlation, by way of example? Okay, now that's what that line shows. Okay, and it shows how much, okay, at about 7 or 8 or so, I cut my risk in half. That means I've doubled my return relative to my risk, right? Ooh, that's good. So as I go down this, I then start to understand what the power of diversification is in terms of the things that I'm going to look for. So what that taught me is the magic isn't only, you only need to do this simple thing. The simple thing is to find 15 or 20 good, uncorrelated return streams. Things that are probably going to make money, but you don't know, but have a good probability of making money. And but you have, that are uncorrelated, that have low correlation. That told me that's what I have to go after, right? That's the key. A lot of people think that the most important thing you can do is find the best investments. Okay? That's important, okay? But there is no great one best investment that can compete with something like this. So look at this line. When this comes down, you can improve your return to risk ratio by a factor of 5. Right? 5 times the expected return for that unit of risk. You can't pick any investments that are probably, nobody's humanly capable in an efficient market probably to pick investments that are 5 times as good individually, but so that bad. So it tells me about the power of diversification and balancing risk. So this is the return to risk ratio that happens for each one of those. You know, like if I can get 0 correlation and I have 15 to 20, I'll have an information ratio, return to risk ratio of 1.25. That means my probability of losing money in a year is only 11%. Okay, as distinct from 40% with any one of them. So that's the power of portfolio construction and the power of diversification. Okay, so it tells me what I have to go after. Improve your return to risk ratio by a factor of 5.
So again, I don't think that he does the best job explaining this here, and the lines on the chart, if you're not mathematically inclined, then you're not going to understand the power of this. But essentially what he's saying is if you have something that is, over a 10-year or 20 or 100-year period is gaining 10%, obviously it's going to, some of those years it's going to lose money. And in order to negate your risk, to lessen your risk, to lessen the chance and the frequency that you lose money, what you can do is you can find another 10% asset or another asset that's going to go up whatever percentage, X percentage, and if it is uncorrelated to the first asset, then you significantly reduce your risk. If it's more correlated, if it's 60% correlated, if gold goes up 60% of the time, Bitcoin goes up. That would be a 60% correlation. But when he's talking about a 0% correlation, it'd be, does the price of oil affect the price of trading cards? Those are probably two things that are highly uncorrelated. There could, oil affects everything in our economy, but you're less likely to have a correlation in that than if you had something like a home builders ETF, which is a ETF made up of companies that build homes, and then you had the real estate market index, right? Those two things would be highly correlated. If one of them goes up, you can almost guarantee the other one is going to go up, and vice versa as well. If one of them goes down, they're also going to go down. And so the math on this kind of makes it like, oh, what is he talking about here? But the main thing when he's talking about these return to risk is risking less money to make more and to have less losses. And so what that does is it allows you to maintain that 10% average across multiple years and not just have an asset that averages 10% on those years, but is closer to 10% on each of those years, which is, a very advantageous thing in a recession, and allows you to, for example, the rule of 7. If you increase something by 10% in a compound way 7 times in a row, if you make 10% on your investments for 7 years in a row, for 7 months in a row, or for 7 days in a row if you're trading, then you will double your money. So it makes sense, even if it's a lower percentage, for you to try to make that happen more consistently instead of making 12%, losing 3%, making 8%, losing 1%. You want to try to average out, you want to have as many 10 times and really 20 times or 15 times as much as possible. And basically by having a portfolio that has more, when you're saying 15 to 25 uncorrelated assets, if you have more things that are uncorrelated but still able to make a high percentage, like say 10%, 8%, 6%, something like that, then you're able to more often stay in the green and more often hit your total average in any given year. And this is, somebody managing a hedge fund that's, got a couple $1 trillion in it, I'm sure. This makes sense for Ray Dalio to try to learn, but to pay attention to. But some of the main things that have to do with the shape of this chart that jump out to me is that it's very, very, very important. After about 10 or 11, you don't necessarily need that many more assets as long as your correlation is high. So it eventually levels out. But basically what this is showing is that, this essentially goes to a limit. And it's, something about if you have assets that are 10%, standard deviation, they are going to make 10%, and they are 60% correlated, you're only going to reduce your thing or whatever by down to 8%. No, actually he's looking at this part of the chart for that. So these are all starting from 10, and then okay, so that's annual standard deviation. Okay, so I was explaining right. That overall you're gonna increase, or you're gonna decrease your fluctuation down to 8% or something. I'm not quite sure exactly. I would love to see more of the math behind this. But essentially, there's not as much difference between 10 and 20 as there is between getting your first or your second uncorrelated asset, your third uncorrelated asset, your fourth uncorrelated asset, and up to about 15 to 20. That's about the limit. You don't necessarily need more uncorrelated assets in order to achieve a better risk to return ratio, essentially. And so it's the key here is to have more assets, but you don't need to find 100 things that are uncorrelated. You need to find things that are as uncorrelated as possible. You need to find a good basket of 10 to 15 of them. And you need to understand how to keep your money in them and move them between each other. That's not anything he's talking about here. He's talking about like if I just split my portfolio by 20 pieces and they were all 10% average gainers with a 0% correlation, my risk reward would be phenomenal. It'd be written really hard to lose money. But the main thing here, again, is that you get high returning assets and that you get as many of them as possible. If this number went up higher, if we were looking at 15%, 20%, this number would also be further out and the curve would change, but no matter what, it's always going to hit a limit. So he basically just had, math with somebody on his team, or maybe he did this by hand because he's about the GOAT of investing. So he had somebody do this on his team so he could figure out using a little calculus or maybe some advanced algebra in order to find essentially at 60% correlation, if these are similar, where am I getting diminishing returns by looking for more assets? So if these are only 60% correlated, like, dude, I might as well stop at like 6 or 7. But if these are uncorrelated, like, woo, it sure does reduce my risk a lot to continue to get up here to 15 to 20. And so that's the main thing when it comes to the correlations, is that finding assets that don't have to do with each other. So this is the advice that my friend gave to the peoples the other day, was that, Robinhood is giving out some free stock. I'm going to get this free stock and I'm going to take that and I'm going to put it into cryptocurrency instead and flip it and make more money. All well and good, except that Bitcoin and the stock market are highly correlated. So I would recommend, especially considering he wasn't talking about Bitcoin, especially considering he was talking about another cryptocurrency that would be correlated with Bitcoin. It would make more sense to keep your money in the stock market because your risk to lose is not nearly as high as it is in crypto, especially buying right now, based on how the charts are. So like if we're looking at, for example, pretty much everything in crypto would not be a 60% correlation. Everything in crypto to Bitcoin would probably be like a 90% correlation. And Bitcoin itself is probably sitting on like probably over 50% correlation with the stock market right now and with gold. Like lots of these things are going up together, and that is what happens, is that these things go up together. And that's part of the first point that I was making, is that these things rise together with public sentiment and essentially the productivity of humanity. But it's really easy to get confused to think that that's real numbers and real prices when it's not. It's a real price. Now, it's a real price if you're the person who buys at 300 and sells at 20,000. You just made a tremendous flip yourself. But for people who are in the investing camp, or for people who hold US dollars, which is like the point that I'm talking about when I'm talking about playing markets, is that the dollar is not a static measure of value. There's inflation and there's its power against other currencies that is consistently changing. And so you're not going to be locked into your value until you get out of that asset, right? So you buy at 300, you sell at 20,000. Now you're into dollars. Now, how do you make sure that your dollars are hedged against everything that's happening in the economy? Well, certainly you could hedge it by splitting some of your cash into other cashes, like for example the pound or the euro or the yen. But those things, like pretty much everything in the world economy like that, will have a level of correlation, and some of those will be less correlated than others and will have a negative correlation. Even maybe if which one would probably make sense? If the euro goes up, then the yen may go down. It's probably more if the dollar goes up, the yen goes down, but whatever the case may be, those will be correlated. So you putting yourself into a bunch of different cryptocurrencies, for example, to think you're diversified you're not diversified because those things are going to move together, as you will see. You know, I thought I was going to pull up some more charts, but I see this video is already 25 minutes. I'm going to be rambling about playing markets, and I'm not even sure that it's clear. Sounds like I need my own whiteboard and, you know, some stuff like Ray Dalio so I can put this out in an organized way. But in order to, again, if you want to build money, if you want to build wealth, then you have to make sure that you keep the money that you have, at least as much as possible, that you're not losing it, you know, which are things that can just happen. Like if you go back and look at what happened to Germany just before, you know, World War II, and their ridiculous bank run where I think it was the Deutschmark just lost all of its value. It was just gone to nothing. And so people were spending their money as quickly as possible. As soon as they got paid, they would go spend their money because the next day it was going to be worth less. And in order to have, like another thing that Grant Cardone says, to get rich for sure, instead of worrying about don't get rich quick, get rich for sure. You need to make sure that you understand how to protect your capital. And so that means, like, dude, the stock market may crash. Where does your money need to be? Well, lots of people think gold. Well, it doesn't need to be in gold, because when the stock market crashes and people lose their job, people are going to sell their gold to get back into dollars so they can buy food. And when all these people sell their gold or sell their Bitcoin, that's going to go down. The same that the US dollar, the same that the stock market, and these other things are going to go down. Finding truly uncorrelated assets to something like the stock market is a really difficult thing to do, because the United States stock market and generally all economic markets are essentially a measure on human productivity. There's more people coming into the system, so it's growing essentially, and there's more technology and people individually get more productive. So it continues to grow. But the issue comes in is those black swan events. Where does your money need to be when the things go? And then within those specific things, so for example, within this could be a breakdown. Like he could do the same exercise within his stock portfolio, that within all of his stocks, he wants to find the most uncorrelated stocks he possibly can in order to maximize the value of that slice of his pie that is his stocks. But then he may have another slice of his pie that is his commodities. And within those commodities, he's going to want to have uncorrelated commodities, and then real estate, and then whatever brackets around that make up his overall uncorrelated assets is 15 to 20 uncorrelated assets in that pie. But then within that pie, so for example, if you just chose, instead of having a stock market pie, and you said, well, this is just going to be my Apple stock, well, that's plenty uncorrelated with this REIT over here, or that's plenty uncorrelated with this specific asset over here. The issue with that is that specific stock can take a big fat L, right? So you'd want to diversify that stock to be a bunch of different stocks, to be an index fund, to be something like something like this within that slice of the pie. And so that's why Ray Dalio gets paid the big bucks. Why I can't wait to give him some of my money as well. Obviously got to have $1 billion or something like that for him to even take it. But that is essentially playing markets there. It's understanding how to have your pie, and then not just how to have your pie, but how to move your pie when things hit the fans. How to have a plan to retain your value in times when the overall sentiment on productivity, the whole stock market, the whole market, all the economy starts to go down. What do you need to do with your money right then? Put it all into dollars while dollars are losing their value? Right? And so there's a big, it's a big problem with a not a simple solution. There's a lot of working parts to it, and as you progress through your financial journey, what you need to do may change. Like, dude, if you only got $1,000 and you just want to throw it in the crypto market, like, me, for example, it would not hurt me to just throw this money that I have in here, just keep it in Bitcoin and let it do what it wants to do. I only trade my crypto to get the skills in trading so that I can understand how to have a whole bunch of charts up here that are Bitcoin, gold, uranium, oil, like all of these different things and be able to chart them and understand where I want to put my money at which times based on the macro cycles, and then also be able to take advantage of micro cycles like catching this bounce, catching this pullback right here and letting that thing run, because I see that, hey, over here there's people who are making, they're doubling their wealth, they're tripling their wealth, they're quadrupling their wealth, and me in terms of my rank is now deteriorating because other people are gaining value. And as systems collapse or whatever else, your rank becomes a lot more important than how many specific dollars you have, because those dollars may be losing value as well. And like, you might be lucky that you bought that new car last year, because now, even though it still may only be $18,000, that $18,000 means more. Part of it, you have to live through it. You have to get lucky to make the right decisions and be in the right time and place when those things happen. But you also have to educate yourself well enough that you understand the threats to your, your nest egg, and that you can strategize and plan and create if-then sequences for your money as it grows. And if this happens over here, that I can bank off of it, or I can mitigate my risk from it, whatever that thing may happen, and especially considering there's things happening over here, there's things happening over here, there's things happening over there, and it's, it doesn't stop. So money is a big thing. Just want to make a quick 30-minute video on playing markets and the concept, and talk about it a little bit, be able to show this video to my friend, and have him really be able to open up a conversation with him about it, so that I can really learn more. That's like essentially why I try to teach or learn anything to the point that I can teach it, so that I actually know it well. That's certainly it can reward other people, but I'm not trying to act like it's not selfish at all. This is obviously going to go on my playing market page, at least at first, while I figure out all of my different things under playing market on my website, playing markets on my website. But that's enough for this one. I will shut up and let you get back to doing whatever you're doing. If you watch this video, thanks. You're the real MVP. Please make fun of me because it's terrible. But that's it for this one. Forgot my intro. Zach Bradshaw, along with a guy. Till next time. Peace.